this day started pretty cool, right? But now it finished another down day in the wake of the big bad Fed meeting. So we decided to get a little more optimistic. We think it's time to sort amongst the rubble, given the incredible declines that we've had and now oversold conditions that exist, to see if it lasts. There aren't some higher quality bargains somewhere. The last couple of months have been an absolute bloodbath. Ever since late November, I've been warning you to circle the wagons around boring companies that make real things and provide real services and generate real profits. The investing club is sick of hearing that. I don't care. It's right. If you took that advice, your portfolio has not necessarily made a lot of money, but it's held up much better than those who tried to stick with the formerly high-flying stocks with no earnings that have been annihilated. But in some nooks and crannies, I think the selling is actually going too far. Too many babies getting thrown out with a small-cap bathwater, perhaps. So I want to start searching for bargains in the hardest-hit group, simply because the declines have been so severe. Remember, some stocks actually do get cheaper as they go lower. So how do you gauge what may actually be cheap? Well, what we did is this. We ran a screen, a very basic screen. We took a look at the Russell 3000, 3,000 largest publicly traded companies in America, and we searched for any stocks that are both down 50% from their highs, okay, 50% or more, and that also sell for less than 50 times earnings. Down 50, less than 50. In other words, we want huge discounts, but we also want quality companies that are actually profitable, meaning their stocks got cheaper as they went lower. Now, within the Russell 3000, there were 2,446 stocks that are large enough for us to talk about on air. Within that group, more than 81% were down, at least 10% from the 52-week highs as of last night's close. Just over half were down at least 20%. That's bear market territory. More than a third of them were down at least 30%. Still not low enough for us. Over a fifth of them were down at least 40%. That's some severe widespread damage. But we wanted true bargains for you, stocks that are down at least 50%. And you know what? Of the 2,446 names in the Russell 3000, that we can cover, 360 of them were actually down 50% or more from their highs as of last night's close. That's almost 15% of the total. Think about how concentrated these losses are. Now, for the second screen, though, how many of these down 50%ers also sell for less than 50 times sales? I mean, sorry, times earnings, not sales, times earnings. Well, okay, 5 of these didn't have any consensus earnings, so we don't know for 2022. So now we're down to 355. Within that group, 205 of these companies are expected to lose money this year. We don't want any of those. We've now got a clean list of 150 stocks out of 3,000 that are both down 50% and are also profitable. But maybe profitable's not enough. We want names with genuine value that sell for less than 50 times earnings, even though 50 times earnings is still pretty expensive. And lo and behold, in the end, we were left with 110 stocks that made the 50-50 list, down 50% from the highs and trading at less than 50 times earnings. Frankly, you know what? I got to tell you, out of 3,000, I thought that 110 wasn't bad. I mean, 3,000 down to 110, it was a heck of a lot more than we expected. I didn't think anything we've gotten that cheap. In a tough tape, this is the kind of screen that is the starting point, though. It's not any more than that. Now, I'm giving you the starting point. Let's take a look. Now, 11 of these large capitalization companies with valuations north of $10 billion. And that includes Moderna, you know them, Zoom Video, Biogen, Twitter, Rocket Companies, Viacom CBS, Pinterest, Etsy, Discovery, Enphase, and Clarivate. So you've got COVID-era darlings like Moderna and Zoom, where Wall Street's now concerned about a future post-pandemic slowdown. Biogen's the drug company with a seemingly sketchy Alzheimer's drug that you know I don't think is good. That got approved last summer. Stay away. You got a pair of downtrodden social media stocks that have some interest to me, Twitter and Pinterest. Rocket, largest mortgage company in America, really tough to own with the Fed. Fed about to tighten, forget about it. You just can't do that. As for Viacom, CBS, and Discovery, they're only in the list because their stocks got bid up ridiculously high by a hedge fund that was manipulating the market. So Clarivate, that seems interesting, right? It's a life science tech play. I don't really know it. I'm cracking the books on it. That leaves us with Etsy and Enphase, both names that we called out from the CNBC Next Gen 50 Index on Monday night. Etsy for e-commerce, very good. Enphase for solar, I like. I think those are actually buys. This is a pretend, and maybe just give it some time. And this one, I think, is really interesting. So of the plus 10 billion, I'm liking Enphase, I'm liking Etsy, I'm liking Twitter, and maybe Pinterest, all right? So now let's go down another tier, going smaller. There are 10 mid-cap companies that made the list with valuations between 5 and 10 billion. And that's Avis Budget, UWM Holdings, Upstart, PennNat, Marivel Life Sciences, The Gap, Altice USA, Playtika Holding, Novavax, and Boston Beer. Avis, the rental car business, has seen its stock fall 70% in the last 3 months. I like the business, but earnings are expected to fall off a cliff starting next year. So maybe its seemingly cheap valuation is misleading. UWM's the number 2 mortgage originator in America. They've been on a couple times. They'll tell you they do better than the competition in a rising interest rate environment. Now, I don't care. This one just hasn't worked. It's been a nightmare. Upstart's the company that uses artificial intelligence to make FICO scores obsolete. This stock got bid up way too high during the fintech love affair. Now it's back down. I don't know if it's cheap, 43 times earnings, but they're real, okay? So we're going to stick with that. Penn Nat made a big bet on online sports gambling, an industry that's way too competitive for me right now. Maybe after COVID and before the big giveaways to get customers in, it's good. I don't know. I think so. Marival Life Sciences has technology that enables all those mRNA-based COVID vaccines, so it's the same as Moderna. Post-pandemic don't work. Gap is down huge because they totally screwed up the holiday season. Maybe they've been punished enough with the stock selling at less than 10 times earnings. Intriguing. Altice, broadband and cable provider, seems to be struggling. No thanks. Playtika, Israeli mobile game developer, missed last quarter after Take-Two's big bid for Zynga. Is that for Zynga? No, I'm not sanguine about that whole industry. Now, as for Novavax, Zynga was great. As for Novavax, I say I like Novogratz, not Novavax. No, thank you. I really haven't been able to get the FDA approval that they've been telling you they're going to be able to get for the COVID vaccine. Finally, there's Boston Beer, maker of Sam Adams and Truly Hard Seltzer. Earlier this month, they hit us with a negative pre-announcement because the hard seltzer business has gotten way too competitive. Boston Beer's in the penalty box. Well, I don't know. So I got Upstart, okay? Better than a sharp stick in the eye. How about the remaining 89 companies that made the list, the ones that are smaller than $5 billion? I'm willing to stick my neck out on a bunch of these. Revolve Group is a digital apparel retailer I think has been unfairly punished. The last quarter was excellent. Hey, speaking of retailers, you got Bed Bath & Beyond. You know I think that is worth a lot more than it's selling for. Ollie's Bargain Outlet, I like that. Nordstrom, but family-owned. In a world where even Kohl's can catch a not one but two takeover bids, these could all be worth more than we think. As a member of Ollie's Army, I can't resist that stock. I also think Bed Bath & Beyond's Bye Bye Baby unit is worth the price of the entire company. Call me good. Okay, now, I'm also enticed by Corsair Gaming, the computer hardware play, with its stock down at 12 times earnings. Hey, Logitech had a lot of great things to say last night about gaming. We spoke to them, right? And they're a partial competitor. Unfortunately, this one got bid up by that meme stock crew. Think AMC and GameStop, and after that Corsair pump and dump was over, it never came back. There's also Cerence, an automotive tech supplier that has contracts with nearly everybody in the industry. As the automakers overcome the semiconductor shortage and ramp up production, I bet this one bounces back. I kind of like that. All right? Finally, there's Torrid, a direct-to-consumer brand specializing in plus-size apparel. Symbol's curve, CRV. Stock's been hard hit after a pair of negative updates in the last couple of months, actually. But these problems were COVID-related. Torrid's an $8 stock that's expected at $1 per share. That could be a winner. So I'm going to circle Torrid. Here's the bottom line. After the seemingly nonstop pummeling, we finally have a bunch of stocks that are cheap enough to buy. But alas, I remain committed to my mantra. You need to buy the stocks of real companies that make real things and sell them for big profits that they then return to shareholders via dividends and buybacks. We're done with all the SPACs, with all the IPOs, and thousands of other stocks that just lose money in an environment where interest rates are going higher and the Fed is not your friend. But, hey, I found almost a dozen stocks out of 3,000. Getting there. Stick with Cramer.
Coming up, is the market showing a soft spot for hardware? Don't hit Control-Alt-Delete on the PC makers until you hear Cramer's take on the cohort. Next.
Shepard Smith here. Thanks for watching CNBC on YouTube.